Welcome to Talking Legal with Templars today. My name is Dayo Okusami and I'm a partner at the firm. I've got my colleague, Pamela Ojiego, with me, who's an associate in our finance department. And today we're doing part 2 of that grand startup idea with a focus on funding today. Interesting fact, Q1 of 2022 is not quite over yet, and startups have already raised $1 billion across Africa to date. So that shows that the momentum we've seen from 2020 and 21 continues into the first quarter of 2022. So we're going to drill down into some key aspects of raising finance for that grand startup idea. And a lot of it is circled around what we'd call the MVP, that most viable product you have. Now, Pamela, can you talk to us about fundraising?
The first issue that comes to mind is the term sheet. Now, a term sheet is a summary of all the proposed terms the parties intend to agree to. It sets out the conditions in which the investors and the companies would do business. Most term sheets are non-binding, except for the confidentiality and exclusivity clauses. Term sheets are very essential because they're the blueprint for the formal legal paperwork. It's very important that during this stage of the negotiation, parties, investors, venture capitalists, everyone involved have proper legal advice and quality legal advice to navigate this stage. Okay, great. And that's a very important point Pamela has made because the term sheet is often the precursor to the definitive legal agreement. It can be non-binding. Some term sheets are indeed binding. But okay, so now let's dive down a little bit. What are, in your opinion, some of the key aspects of the term sheet that we should be considering? Some of the key clauses or aspects of a term sheet are the valuation of the company, the right of the investors, securities, liquidation. Okay. So now, and everyone's always talking about raising funding, and valuation is a key point because valuation is a very emotive subject, isn't it? It's emotive because the founders have a valuation in mind. Investors or businessmen would have a different valuation in mind. It's key that that is agreed to, and there are commercial and legal aspects to it. Can you talk to us a little about valuation? Valuation is the total worth of a business. Now, when startups want to raise funds, there's something called the pre-money valuation and the post-money valuation. The pre-money valuation is the valuation of the business before the investment, while the post-money valuation is the valuation of the business after the investment. The pre-money valuation is very important because it determines how much investors would put in the business. If the valuation is too low, investors may be skeptical. If it's too high, the pressure on the founders may be too much. So there needs to be proper valuation before investors can put in the kind of money that the startup's founders are looking to get. Okay, that's an interesting point. And also another key point about the valuation of a company is the valuation determines how much of the company the investor holds post-money after the investment. Okay, so valuation, talk to us about some of the other points that you highlighted. Another key clause in the term sheet is security. Now, securities are very important because this is what most investors are looking forward to. They can be shares, they can be stocks, debentures, convertible notes, amongst others. Most investors opt for compulsorily convertible preference shares. These are shares that mandatorily must convert to equity at a fixed time and in accordance to terms in which the parties have agreed to. The Companies and Allied Matters Act in Section 166 and Section 143 provides different kind of shares and different rights that should accrue to these shares. Now, it's very important for startups, VCs, and everyone involved in this transaction to have proper legal advice to navigate this stage and understand the consequences of each securities and what attached to them. Great, so Pamela has run us through valuation and security. Now, well, Pamela, let's go a bit further, right? Why don't you talk about the other headings on the term sheet that you mentioned? So there are other clauses to consider in the term sheet, but before I proceed to that, I'd like to say something on crowdfunding. Now, Section 22 Sub 5 of the Companies and Allied Matters Act 2020 prohibits equity-based crowdfunding. This is irrespective of the Securities and Exchange Commission guideline that was released in 2021. This may seem like divergent laws or provisions. However, investors and startups need to know this provision, need to be aware of it, so they would understand how to navigate this properly.
So now, the Securities and Exchange Commission guidelines of 21 provide for crowdfunding, but the Companies and Allied Matter Act prohibits crowdfunding, equity-based crowdfunding.
Yeah.
So we have a dichotomy between the Companies and Allied Matter Act and its authority, the Corporate Affairs Commission, and the Securities and Exchange Commission, which released the crowdfunding guidelines. So parties need to be aware of that dichotomy. Okay, thank you for that, Pamela. Now let's talk about those other headings under your term sheet.
One other heading or one other clause that parties should be aware of and understand is the rights of investors. Now, investors, when they bring in money, they have certain rights that they expect. These rights may be political or economic. Economic rights, we talk about drag-along rights, right of first refusal. While for political rights, we can talk about voting rights as provided in Section 140 of the Companies and Allied Matters Act. We talk about board membership. Now, these things are key terms that will be contained in a term sheet, and parties need to be aware of how this will be shared, what rights will be accrued to people, the extent of these rights, and the consequences of these clauses.
Okay. So now we've covered valuation, we've covered security, and now your last point, which you've just spoken upon. Thank you for that clarity. Are there any other things that parties should be aware of on a term sheet before we close out this episode?
So parties should also be aware of liquidation rights. Now, in the event of liquidation, who gets what? Who gets paid first? These are key things that must be considered and negotiated properly in a term sheet. Liquidation doesn't necessarily mean the folding of the company, but mergers and acquisition, selling of the company, buyouts, these are also things that fall under liquidation. The liquidation rights are very essential because investors would like to have confidence that their investments are secured in the event of a buyout or a merger or the closing of the company.
Okay, so thank you for that, Pamela. So you've just basically talked about a liquidation event, which is just as important as every other thing, but ties to the money like a valuation. Because a liquidation event, like you rightly said, is not the companies being liquidated or wound up. It's usually tied to another round of investment or cash being drawn out. And where it is key for investors as well as founders of a startup is that you need to know who has rights under a liquidation event. So that's very key. Thank you for that, Pamela. Now, one thing we will talk about later is what happens beyond the term sheet, because we mentioned definitive agreements, and there are a number of them, including safe agreements or subscription agreements, but that would be on another episode of Talking Legal with Templars, where we'll come back with part 3 of your grand startup idea. Thank you for your time with us today.